Hi class, this video is going to run through how to complete exercise 15.4 of your textbook, which is all about how we complete journal entries and report depreciation using straight line method. Again, I always encourage you to follow on with me, so textbook page 303 and workbook page 270. Let's have a look at this question and see what we need to do and highlight the key details, because that's probably the most important in this question, is identify what needs to be done and the key inputs to work this out. So we're Rex Payne, the proprietor of Terranium Rex, and we sell terraniums and associated gear. On 1st of July, again remembering dates, super important for depreciation, he has purchased new shop fittings for $12,000 cash, and he's decided to depreciate them at 20% per annum, using the straight line method. The books of the business close 31 December each year. I've highlighted the key important information that we need to use to identify what we need to do. Part A asked us to prepare the adjusting and closing entries, so we're going to highlight those, so we're going to really understand what we need to do. Adjusting and the closing entries for the years ended 31 December 2023, 24, and 25. We will do that question. We will not complete the general ledger accounts in this video, but you will follow the journal entries or look at the solutions for that. Then we will look at how this would look like in the balance sheet for 2023, 24, and 25. Let's run this through. Obviously, the first thing we need to do is what is the depreciation per year. Now, this is slightly differently. Normally, we are told to work out depreciation by working out the cost minus residual value over the useful life of the business. We have not been given enough information. We have, however, been given a depreciation rate. We work out our depreciation per year by our cost now times the depreciation rate, and that equals $12,000 times 20%, which means it equals $2,400 per year. That is the amount of depreciation per year. Now, we are going to complete our journal entries for all of these periods, and you can see I've given you the dates already. We're going to have to record the adjusting, so that is the actual depreciation per reporting period. And then we're also going to have to recognize that one of the debits or credits that we make is going to be an expense, so we're going to have to close it to determine profit or loss. So we have shop fittings. The first thing we're going to have to do on 31/12, so 31st of December 2023, is record the depreciation for that period. We are going to record this as depreciation of shop fittings. And we're also going to recognize that there is an accumulated depreciation of shop fittings, and hopefully you will have more room than me. Now, important to understand is that we have $2,400 of depreciation per year, but that doesn't mean that we've had that amount of depreciation for this reporting period, because we purchased this on the 1st of July 2023. So how many months has this been? It has been all of July, August, September, October, November, and December. It has been 6 months or half a year, which means we have had $1,200 of depreciation for that period. So that means our narration is going to be, we will follow the template. It is an adjusting entry. We are going to say that it's for 6 months, for 6 months depreciation. And it is using 20% straight line method. That is going to be your template for each of your narrations. We then have to recognize that one of these is an expense. What have we done in this record? We have done a debit to record that an expense has gone up. And then we have also done a credit to record that we are essentially saying our assets are going down. So we need to do a closing entry to close the revenue and expense accounts. The expense account here is depreciation of shop fittings. And to close it, we need to make it zero or balance. To start again, we have a debit balance. To close it, we do a credit. And hence our debit credit is depreciation of shop fittings. And where does this go? It goes to our scorecard, P&L summary. We have to make the assumption that we need to do a narration because it says narration. It doesn't say narrations aren't required. A simple closing entry narration is fine. We are then going to work through doing the same process for 2024 and 2025, all the way up to 31st of December. The important bit to recognize here is that this is for a full 12 months. So it is no longer 6 months or $1,200. This shop fittings will depreciate by 20%, the same 20%, so constant $2,400 per year. So this is actually, even though it looks intimidating, a lot of journal entries, really quite simple. $2,400 of depreciation for the period of 2024. That means we have a new expense, depreciation of shop fittings. And we have done this to reduce our asset, so we've got accumulated depreciation of shop fittings. Now, I'm not going to keep doing the narration because it's going to be too busy. We would follow the exact same narration here, but it would no longer be 6 months. You could say 12 months or 1 year, or just say adjusting entry for depreciation, 20% straight line method. We will obviously have to close this to recognize that we have another expense, and this will be the same record as we did in the 31st of December 2023, P&L summary, depreciation of shop fittings. And again, the same narration as we did here. Now, we're going to do the exact same entries in 2025. So we don't have to, in this video, bore you while doing that. You're going to pick this up and record this here, and pick this one up and record it here, because there's been the same 12 months of depreciation. 2,400 of depreciation of shop fittings, 2,400 of accumulated depreciation of shop fittings, and then we're going to close that off to our P&L summary and make our expense account back to zero. Just double check the solutions to be clear that you know what you've been doing to confirm your narrations, but that is the process. You would then use all that information to pick up and record this in your shop fittings ledger, your depreciation of shop fittings, and your accumulated depreciation of shop fittings ledgers to identify all the information that you need to update. Now, the bit that we're going to do is think about what our balance sheet would look like for 2023, 2024, and 2025. Now, that looks intimidating, but really, it's quite an easy bit of work. We've done the hard bit. We're going to have an extract that has non-current assets, and we're going to recognize that this asset is called shop fittings. And we're going to do this for 2023, 2024, and 2025. For each time, the asset's historical cost is exactly the same, $12,000. What we need to do is less the accumulated depreciation. So how much was there of accumulated depreciation up to the end of 2023? There was $1,200. We would then add $2,400 to that, so 36, and then we would add a further $2,400, to get to 6,000. That means our assets at the end of December 2023, we're estimating these shop fittings are really worth $10,800 in terms of depreciation, $8,400 in 2024, and $6,000 in 2025. Importantly, this does not equal really potential current value. What it is our carrying value. It is how much our asset was worth in historical cost minus our depreciation, and this will be an important calculation to recognize that some of the revenue earning capacity of these assets has been used up. Part D asked us to explain depreciation in terms of the qualitative characteristic relevance. Why do we do depreciation? Why does it make our reports more relevant? Remembering relevance is all about decision making. How are we making our reports more relevant, allowing us to make better decisions due to depreciation? It's important because we need to understand that depreciation is incredibly important to decision making because it represents a more accurate representation of our assets. Otherwise, if we didn't use it, we might be overestimating our assets. We keep saying we have $12,000. That could give us a false sense of security. And it also might overstate our profit, which might also be a bad thing because we're not showing the actual cost of our assets. So why is depreciation super important in terms of relevance? Because it accurately represents the value and the cost of our assets, which is incredibly important because we want to understand our true value of our assets, because ultimately that's going to come into how well our business is running. Have a quick look at the solutions to that and maybe craft an answer for yourself. But that is how we complete parts A, B, and D for this question. And I know that you've got enough knowledge of general ledgers now to pick up this general journal and do your general ledgers in part B, particularly if you have a quick look at the solution. Well done for completing this question, and keep practicing your